Hello everyone and happy new year first of all. So welcome into the channel. My name is Brent. Welcome to Brent Investing. So in this video, it's been quite a while since we've done a full recap of the M1 Finance portfolio. So we're going to be covering a lot of information here quickly. We're going to go over the update of the portfolio. We have been on this platform for 5 years as of the 7th of January 2023. We will have been on M1 Finance for 5 years. So that is insane how much we've seen this platform change in that time frame. So we're going to go ahead and number one, go over the updates in the portfolio, and then we'll take a look at the individual holdings. We have 25 holdings within our dividend portfolio. So we're going to take a look at the 25 holdings, and we're going to be looking at them over the past year. Let's take a look at their performance, take a look at their price, their current yield, which positions are offering some of the best performance. And then we'll go over the weekly and the yearly recap performance of their portfolio, just to kind of take a look at where we are standing right now at the very beginning of 2023. The markets for the 2023 have not yet opened, so everything here is over the past 1 year. So with that said, if you guys are brand new here to the channel, definitely go down below, give this video a thumbs up, would really appreciate it. Also subscribe, make sure to hit the bell and be notified by all notifications. If you guys have comments and suggestions for upcoming videos or looking at specific companies, let me know down in the comment section below. I do appreciate your guys' comments, and let's go ahead and get into the video. So as we were saying, we have been on this platform since 2018. So in just a few days away, in 4 days as of this video, we will have been on this platform for 5 years. So we've done a lot on this portfolio. We started with, essentially every portfolio starts with $0. But if we look at our funding history, we can see here in 2018, we contributed $11,000. That is because we put $5,500 towards 2017. This was a new platform at the time, so the way that they kind of have this chopped up looks kind of weird, but it doesn't ever, it's whatever year you funded specific stuff. It doesn't take into account when I removed money. So for the Roth IRA, we had some issues here where towards the end of the year, I wasn't able to contribute $10 or anything less than $10 to contribute. Got to withdraw money and let them know as to why I withdrew it, and then redeposited it. But they took it as, never actually withdrawn, and they just kind of left that in there as a weird funding issue. But this $11,000 was broken between 2017, 2018 was $5,500 per both years. This is actually $6,000 here. And then every so year afterwards, we've been $6,000 contributions up until 2022. Here in 2023, guess what? The limit has been increased to $6,500. So I just posted this here in the community tab. I said, Happy New Year's, everyone. It's about 2 hours ago. So Happy New Year's. Remember, 401k was raised to $22,500, IRA and Roth IRA to $6,500, and HSA was raised to $3,850. So those are pretty, some pretty good raises. I like the Roth IRA change, of course. It's $500 extra. $500 extra you can deposit into your account. So that'll be very nice and handy going towards our retirement. So let's take a look at the M1 Finance account, and we'll take a look at the overall performance here. Overall, we started the year pretty positive, but throughout the year, there was a lot of ups and downs within the portfolio. And we stood in this portfolio standing as it is right now, up 50.81% since it has started about 5 years ago. This has made $4,078.53 in just dividends alone. So as of starting this portfolio, we have broke the $4,000 threshold for how much dividends this portfolio has generated. And these don't ever go away, right? The dividends that you receive in your account, they go towards your buying power, and then that buying power can then be used to buy companies within your portfolio. We have close to $2,300 in just straight buying power, so it could be some good opportunity to just begin buying here shortly. Our market gains are 5,529, and this is after the portfolio did take a bit of a dip in 2022, and I believe in 2021 as well. It's been quite a while. I don't remember the gains here, but you can see over the past 1 year, the portfolio is down roughly 8.17% with dividends included there. So otherwise it would be down probably, 9 to 10%, I believe. Now, if we do a comparison against the S&P 500, let's do a 1 year on all of these main indexes, and we'll see how our portfolio has compared. And this isn't taking dividends into account, I believe. So S&P 500 over the last 1 year is down 19.44%. The Dow Jones, the 1 year, is down 8.78%, and the NASDAQ is down 33.10%. So overall, I do believe that our portfolio sat pretty well in line, especially against, the S&P 500, the Dow, and the NASDAQ, which are where we usually like to compare our portfolio. Is kind of in between the S&P and the Dow Jones. We do have really good performance in here, and we don't have a whole lot of volatility out of a lot of our names. So that is why our total return probably sat around 9 to 10% versus, say, the Dow Jones sat around 8.78. And ours is a lot more diversified. Oh, actually, no, not really. The Dow Jones has 30, right? So our portfolio has 25. So they're pretty well about the same mixture of companies within them. And if we go ahead and sort this by over the past 1 year, which has been the best performers, our number one position was Merck at 50.74, Lockheed Martin 44.38, and AbbVie. So pharmaceuticals and a defensive company in a time, 2022. Starbucks was a new position that we added into the portfolio, and that has been our number 4 pick for the year. So that is nice to see these positions having, risen as much as they have. Our worst positions for the year, and there are quite a few. You can kind of see here, there's actually more red versus green. That kind of goes with the negative of the positions overall. Our worst positions this year, IIPR. This is a real estate investment trust with the MJ industry, down 58.53. Not as down as it had been in the past. It was down around 70% at one point. Stanley Black and Decker, definitely, people are back to work now here in 2022. Inflation's off the charts, and nobody's wanted to do buying all these little handy tools. So that's down nearly, we'll just say 58 point, we'll just say 58% there. Digital Realty Trust is another REIT, 37, would say 38% there. Essex, 37%. So these companies right here, we have REIT, and REIT. So as interest rates have risen, right, that's more expensive. That debt that's on the balance sheets of these companies, they have to refinance that debt, and they refinance it at a higher rate, and that dives into their funds from operation, along with their total expenses just kind of going up because of the interest on those loans. Apple, interesting to see Apple having been hit so hard here in 2022. Cisco Systems, another hard hit. Lowe's, Clorox. I'm actually really surprised to see Clorox having came back up out of that dip. They had been down in the dip of around, I believe, around 30 to 40% down this year. So they've actually popped back up here towards the end of the year. So really nice recovery there, guys. But overall, I'm pretty happy with the performance of the portfolio. So that is the 1 year. Now diving into the final year here of 2022, we did have a negative week here. We can see here our best positions: JP Morgan, Stanley Black and Decker. Look at that. That's one of our worst positions for the year, kind of popping here towards the very end. And Essex Property Trust. So maybe these companies here that were in the worst position in the portfolio are kind of bouncing back. Maybe they're finding a bottom here at the start of 2023. So we might see these names pop up as our best performers for 2023 in the future. We shall see. Our worst performers this week: the Clorox Company, the Siggy Selective, and the Cisco Corp. So pretty interesting. So we're down 0.51% on the week. Let's go take a look at the weekly on the S&P, the Dow Jones, and the NASDAQ here. So the S&P is down for the week 0.14%. So actually not that bad on the S&P. With everybody out of town, everybody kind of celebrating, a lot of the markets were closed and not a lot of money was moving. S&P being down 0.14 is essentially flat on the week. Dow Jones flat on the week at negative 0.07, and the NASDAQ down 0.3% on the week. So pretty interesting that our portfolio is down 0.51, and that's with earned dividends kind of helping it boost a bit. So pretty interesting to see a lot of negativity in our positions here in this final week of the year. But overall, I'm pretty happy with the performance and where 2023 is heading with this portfolio. So that is the overall, the yearly recap and the 1 week recap. Now, as far as our portfolio goes, I don't even know how much dividends we received here in the year. That's probably something I will have to take a look at, maybe just make its own individual video of how many dividends we received in the year. We can see here that we earned, this kind of gives it a pretty good snapshot right here. We made, over the last 1 year, this portfolio has earned $1,265.22 in dividends. So it's fairly close to this number, but there's going to be some amount of earned dividends that were made probably here that, that might actually be fairly accurate. Our goal for 2023 was to hit, or is to hit, $1,500 of earned dividends. So we're going to get close to there. Every year that we're building this portfolio, we add about $6,000, right? And if we bust out our calculator here, if we're adding about $6,000 added interest or a yield of around 3%, so, you add $6,000 into your portfolio and you're adding it at about a 3% yield, right? That adds up to be about $180 in annual dividends that you're kind of adding to your total amount. But you also have this ball of yields and this ball of portfolio in the background behind it that's also, having generated dividends, and those dividends are buying back more shares. So here in total, we will actually have close to $7,265 in cash that's being reinvested in this portfolio throughout the year. And if we add 3% to this, our total dividend income, if we buy around 3% on average yield, which there's quite a few companies out there that'll average around that throughout the year, we should increase our portfolio income by roughly $217.95. And that's a really rough estimate. So we might keyword be close to about $1,500 of total dividends by the end of the year. And I can track all of the performance and our yield and our income here in the dividend tracker. This is called trackyourdividends.com. And not to mention, all of the companies in our portfolio raise their dividends, right? So I don't even have to invest a whole lot more, right? By the way that this number kind of grows here, our annual income as it stands right now is closer to $1,302, because every single company within our portfolio will raise their dividends sometime here in 2023. So by the very end of 2023, our annual income in our portfolio, without having touched anything, could rise by, say, $30 to $60. And then we have the additional money that we're invested into the company. So yeah, we that's our new goal here for 2023. And now kind of into the final thing. I haven't really looked at a lot of positions in our portfolio, and I haven't really purchased anything either. If we look at the activity here, we kind of went over our last video back. Where is it? Videos. Our last video was about 3 weeks ago now. And in that video, we went over our activity where we hadn't really purchased anything in quite a while. If we, there's nothing purchased here in December, very little purchased in November, if anything. Let me go look. I don't see anything purchased in November. And I don't see, oh, there we go, September. September was the very last time that I purchased anything and I sold anything. And that's why we have this big old bundle of cash just kind of sitting there. I'm looking for opportunity. I'm just looking for, where do I want to invest my capital? And that is where we're going to go and take a look at the Fundamental Charts Creator. And I have all 25 holdings in this tracker here. So if I go to my holdings right here, I can see that I have 25 positions. My cost basis with dividends included is around 39,000. This is I'm going to say that this is probably pretty incorrect because my cost basis is actually closer to my funding history, right? This is my actual cost basis. This is what I'm kind of using as it, right? So we added $11,000 in 2017 and 2018, 6,000 in 2019, 6,000 in 2020, and another 6,000 in 2021, and another 6,000 in 2022. So our cost basis is actually closer to about $35,000. And the reason here it shows that our cost basis is 39,000 is because every year we've got dividends in this portfolio, right? These dividends have gone and been reinvested back into our portfolio, raising our cost basis from our initial deposit of 35,000 to $39,740. So that means that there is how much? 35,000. There is roughly $4,740.25. You know, we can see here the earned dividends. There's probably some amount of. We also received not dividends. What were they called? A long time ago, we used to hold not REITs, but there were other kind of companies that paid out different stuff. They weren't dividends. They're not even kind of here. I forgot the company that I'm kind of thinking of, but they paid out portions of capital instead of dividends, so it was marketed different, and that counted. You know, it kind of acted like a dividend, but not really a dividend. It wasn't taxed the same. It was out of BDCs or man, what is the other company? I can't think of them right now. But they were just taxed a little bit different. You know, they send you the K1s and you have to mark them a little bit different, even when they're in the Roth IRA. But I can't think of the name. But that's where the difference of money is coming from. That almost $5,000 has been paid out in cash in the form of dividends or something similar and reinvested into the portfolio. So now we're going to take a look at these 25 holdings and we're going to go through them fairly quickly because, you know, we could end the video here now. But I'm really interested in where we are at 1 year into this. You know, all these have moved over the past 1 year. And I want to take a look at where they are at and what they are offering, right? So Apple here, for example, is down, what was it? It was down a good chunk. I don't know how I want to do this. Do I want to just look at the face value of the price and the yield? Or do I want to look at the percentage? And it would be nice to see these kind of side by side, but we'll take a look at the normal, just unchanged data. So we can see that Apple had started the year around $180 and now priced at $130. So that's a $50 markdown on the price of Apple since they started. And you can see that the yield went from a start of the year of below 0.5% to now 0.7%. So the yield here on Apple really hasn't changed a whole lot, but you are getting that nearly $50 difference in price. Avi here. Oh my goodness, yeah, Avi. Just a couple years ago, just to kind of put this in perspective, Avi used to have a starting yield in the 5-6% range back in 2019 and 2020. That would have been the insane time to purchase Avi. Down when it was in the $60 to $80 threshold. It had been there for quite a while. And I did pick up quite a bit of Avi on my my Merrill Edge portfolio, and I held it for quite a while. I sold out around like 130, 140. I didn't really get this peak here, but I did sell a good portion of it towards the top as well. I don't remember where it was at, but I was like, man, look at this run up. I need to sell just a little bit of it. But it has came back up, not near to that top, but look at the difference in the yield. You're getting a 2.62% yield versus just a few years ago or months ago. You know, prior to 2022, you could have got a 4% yield. Whereas now you're locking in at a very high price of $161 and a yield of 2.62. So I feel like this one is a little bit on the avoid side, right? I probably wouldn't be buying more Avi. I'm pretty happy with the position now, and I'll let it ride, but I will not pick up any more of Avi. ABM Industries. Price at $44.42 over the 1 year. It's actually up on the year. You can see here it started around 40, now gained $4 at 44.42. The yield started around 1.92, not that high, probably around like 1.8, and came down to 1.3. So ABM isn't looking like an opportunity at the moment. We have Avery Dennison. It came off its highs at around $212 to $220. It is now priced at $180, so it fell about $40 in price, $30 to $40, and its yield went up from about 1.25 to now 1.62. This is one that I'm not really too confident in. I remember purchasing it, but if it at the time, like everything that I may have researched on the company and why I purchased it, it's just been in the portfolio for so long that it's in the back of my mind. It's just lost data at this point. Colgate, everyone knows Colgate. They sell toothpaste and many other household products. This one had lost quite a bit throughout the year, and it did have some good bounce backs, but nothing ever stuck with it. And throughout the year just went down, up, and then just kind of lost it, and then has recovered some, but just not quite back to where it had been priced. It's still off by about $10, which isn't too bad. Its yield did increase here from around 2.10 to 2.36, so you are getting a slightly better yield. But I feel Colgate's one of those companies that just doesn't have a whole lot of products that really push it over the edge to make it very competitive. Clorox here started the year really high price because of 2020 into 2022. And then when the whole thing just kind of stopped and everybody went back to work, the products weren't needed to sanitize, everything reopened as if it never happened. And, Clorox fell off a cliff, went from about 180 and some change to 140. So it is down $40 off their high. The yield did go up from about 2.42 to about 3.33. So you are still getting a pretty high yield when buying into Clorox, but it hasn't really stabilized. You get a lot of these price swings here. If you can nab it between 125 and 130, like when it dips into that 125, 130, that, over the past few dips, it does look like it always does recover. And those could be good buying opportunities. So those could be thresholds to set. Cisco, this has been one, Cisco is one of those tech companies it's really hard not to like it because it fits like a specific, what's it called? Like a niche. Like when you go to buy network gear and you're working in a small mom and pop shop, you might buy Netgear, Juniper, and stuff like that. But as you go into the larger companies, most of the larger companies really only go with Cisco or Aruba equipment. And this is one that the way that they've changed their business model has really pushed off a lot of businesses from using Cisco products. So this is one that I feel like if they don't make a lot of changes in 2023 with the way that they're kind of pricing their models or the way that they're kind of doing their systems, this could begin to continue fumble around. It does look like it kind of went back up off their lows of $40 to 47, but it just, that's their stopping point, right? It has a really, really hard time breaking above that and keeping it. And we'll see where this goes. I don't feel too confident investing into Cisco, but at the same time, I don't know another company to have put cash into. And I've had the discussion with a couple other investors in the Discord and in someone's Discord there, and also in the chats and the comments here. Digital Realty Trust down in the dumps here, priced at $100. Started the year a little bit below 180. So it's now went from a yield of 2.8 to now 4.87, and it maintained that yield, or will this price continue to fall off a cliff? It doesn't show any signs of recovery right now. So this could just be one to kind of hold off, don't touch it with a stick, and just leave it be for now. Same thing with Essex Property Trust. I mean, this thing is just off a cliff and just no signs of recovery. Price at $211.92. Hormel Foods here. Started the year around, looks like $48 and some change. Now priced at $45, so it hasn't lost a whole lot. Its yield went from about 1.4 to 1.71. I don't know why it has these crazy fluctuations with the yield here. You know, 1 minute it's at 1.7, the next it's 2.25. The price really doesn't change a whole lot in that time frame. So I don't know if this is, I don't know what's causing the valuations there with the yield just kind of flying off the charts. Innovative Property Trust. This is another one I probably wouldn't touch myself just because they've had issues with. They had issues. I haven't checked up on them in quite a while, but their price is again similar to Essex Property Trust and Digital Realty Trust. It has just fallen off a cliff. I'm gonna go ahead and reload everything here. J&J. My site's not even loading. Okay, there it goes. Did I lose my internet? Luckily, when I record, my OBS always captures everything, regardless if I have internet or not. But when I'm having to use the online services to pull information, that's just like a whole other thing there. So Innovative Properties, right? Priced at $250. This is basically Facebook right here. The REIT of Facebook. No, price at over $250. Now priced at $101. It lost $150 per share. Went from a yield of 2.4 to 7%. So can it maintain this yield, or will it have to cut back its yield? That will be the future. I don't know, honestly, and it doesn't look to having any signs of recovery. It does look like it found a bottom here, but you know, it tried to go back up. They tried to recover and just couldn't find it, and it's on its downtrend right now. So we're gonna retest this here back in September lows, you know, October through September, and we'll see if it tries to make another recovery. Another one again, I guess I wouldn't touch. I wouldn't touch it. Johnson & Johnson. This was interesting, right? We have a nice, you know, crazy price movement throughout the year, but hey, 1 year later, they're priced higher. They started the year a little bit below 172, rose to 176.65. Their yield started around 2.4 and some change. It's now at 2.52, so they got that slow and steady. Johnson & Johnson is just a great company. You can always buy into J&J. They have a ton of products within household and medical that are just kind of used time and time again. And their company, just throughout time, is just slow and steady. You know, even during the crashes here, if we go ahead and punch in, I should be able to add, here we are, recessions. So every recession here, and we just take away the yield just for a moment. You can see the recessions here. They're very unnoticeable blips, like right here. Boop, blip right there, and the price just drops and then recovers, and then has like a period of years where it doesn't really recover, but hey, you're accumulating shares in this time frame, and then it recovers, then it trends for a while. You know, this whole time frame from right here to right here did absolutely nothing from like 2002 to 2012. Can you imagine 10 years of just trending sideways? That's exactly what this company did. But here in 2012, shot up like a rocket. So, I mean, it's doing another pattern like here in 95, where here we had this nice shot up and then it trends sideways for a while. Here we had a huge shot up, and we're going to be trending sideways for a while. I feel with the inflation as high as it is, we may see Johnson & Johnson just kind of trend sideways. We may see it fall. Who honestly knows? But with time, you know, with time, give everything time. J&J is one of those companies that's slow and steady. You just buy it, hold, and own it forever. So that is J&J. Let's look at JP Morgan. Let's go ahead and bring back the yield. And so they fell from a little under 160 to 134, so about $30 difference. They did do a quick recovery here after October, it looks like maybe October timeframe. They had a double dip there with a lower bottom, but recovered out of that quite nicely. They're trending sideways here. And there, let's go ahead and bring in, I haven't been doing this for all the companies, but this one looks interesting. Like, okay, yeah, so they just recently broke above their 50-day and 200-day moving averages, and they're kind of holding it, right? They almost came down to 131, which would have been their 50-day, but they didn't quite go, and they're kind of scaling right above that 50-day moving average. So JP Morgan could be an interesting one to kind of watch. See if it dips below it, it could lose. It could lose momentum and dip below that 50-day, bounce off the 200-day, but overall it is looking pretty positive there. Golden cross, right? We have the 50-day breaking over the 200-day. So it's pretty positive overall. You have your yield starting around 1.6 some for the year, now standing at 2.24. So you are getting a slightly better yield, but again, that price has also kind of come down. But over the last few years, JP Morgan is often pretty good to buy into, except for during that crash. JP Morgan crashed hard, but recovered hard, and then crashed hard again, and just has been in that area where, you know, raising rates aren't actually helping it as much as some would think. Lockheed Martin, defensive contractor, you know, so in 2022, we had a lot of discussions between other countries, and I don't know what I could say on YouTube as far as, you know, what's going on globally in the conflict of the world, but the U.S. looked to have almost stepped in some instances or helped supply. So, go with what you know. And defensive companies is often in times like these are, readily available, making defensive and offensive stuff. So this is probably one that will be invested in and looked into in the future, with no money not really being taken away from it, right? So this is probably a good one to buy and hold, which we're continuing to do here for Lockheed Martin. Lowe's dipped off a truck here. I actually thought Lowe's did fairly well in 2022, but when looking at this chart, wow, they fell from over $252 at the very beginning of 2022. They're now priced at $199, so they lost about $52 and some change, and they're now priced at $199. But that yield went from around 1.10 to 1.86 on the year, and the price did just go below the 50-day moving average, but it looks to be maintaining itself over that so it's it's under the 50-day, but over the 200-day. And if you look at the last 6 months, let's look at the last 1 month here. Yeah, you can see it was trending on that line, but the 50-day doesn't really support it too often. Often, it's more or less just kind of used as a metric just to kind of see where it's at. But that 200-day is the main one. That 200-day moving average, if it falls below and it can't move back over it, it has these instances like this where it fell below it and then it fell below it even harder. It tried to rise over it, had a bit of a break right there, but then crashed pretty hard, rose again, broke really hard, rose again, and it's been kind of trending sideways, or traded sideways for a while and then kind of fell back under. So who knows? I actually wouldn't mind buying a bit more Lowe's at this price. I don't think it's horrible at $199. I know I bought it throughout the year in different spots, but kind of looking at this chart, I'd be interested in picking up as of right now. Over the last companies that I've looked at, I wouldn't mind buying J&J, JP Morgan, Lockheed, Lowe's so far. I think those would all be pretty good companies to kind of add investment capital into. Main Street Capital priced at $36.95 from a high of $44. So only really about $8 difference, but they offer a 6.44% yield. This is a BDC, pretty interesting. Merck, this is my number one position for the year. And you can see a lot of it just came from the last few months here, rising from $90 and under 90 to now 110. It started the year at 78. It rose to 110. So that's $30 difference right there. It had a yield of 3.3%. I remember buying this. It had a really nice yield, over 3%. It now offers a 2.52% yield. I don't know what made it rise to where it's currently priced, but this could be maybe a sell-in opportunity to sell a bit and wait for the rebound. Realty Income priced at a little under 72 at the beginning of the year, now at 63. It did have a nice little recovery, had a huge sharp fall from what was prior to September, August. August into October, had November, December to recover, and just been kind of trending. Here's Pfizer. Pfizer started the year over 57.50. It has traded lower, bounced around for quite a while through the year. I got hiccups now. I don't know where my hiccups kind of came from, but it in August it dipped slow and steady, and then slow and steady recovered. I don't know if this is earnings related right here or media, information got put out for something and that kind of made the price dip down. There's a lot of reasons why companies will do this slow and steady stuff right here and then kind of dip and then recover. But Pfizer also looks to be doing decent, not horrible. They're offering a 3.1% yield. Starbucks here, start of the year at, holy cow, over $115. Now trading at 99. Not a bad. I started buying Starbucks in this year, and I think I'm probably kicked out of M1 Finance at this point. But Starbucks honestly wouldn't be a bad buy. I would wait a bit. You can see this huge run up as of maybe November, December. They were above that 200-day and they came down, hit it, and just recovered really nicely. Bounced off 104 and are now kind of trending in this line right here. So I don't know where they're going to hit, but they are priced quite quite a bit above that 200-day moving average. They're offering a 2% yield versus at the start of the year they offered a 1.6. So they did offer for a period around a 2.6. So they're not at the best yield, but they're not at the worst, right? Siggy Selective Insurance Group. They started the year at $81, now priced at $88. So they did rise slightly. Insurance companies, they don't have a lot of, banks, right? They take a lot of loans. A lot of loans is what they need to grow their business, and they're raising rates, the rising rates. When they loan out more money at higher rates, that makes them better. But if people aren't refinancing, that kind of hurts them, right? Sticky Selective Insurance Groups or insurance groups in general aren't like that. So they don't have to hold, the rates affect them positively with people buying their products and stuff like that. But they're not out there handing out loans and having to refinance and all that. So oftentimes they kind of get the benefits of insurance, of rising rates without all the downfalls, without having a ton of debt on their balance sheets. So Siggy Selective moving slightly higher on the year. They started the year at around a 1.3. They ended the year about a 1.3. The price is below the 50-day, but not quite at the 200-day. So we can see it did have a really fast run up above $96 and has been trending sideways. So could be a good buying opportunity right around 84 or below. Who knows where this one will kind of sit. But not like a horrible yield. 1.29 is kind of a low starting yield. Now Stanley Black & Decker. Wow. This one started the year at $180, lost $105 in value. Now sets at $75. Its yield used to be 1.5. It's now at 4.23. If this company offered other things besides just power tools and stuff along that nature, it might be looked at better. But this company offers really nothing. It doesn't offer a whole lot of services. It doesn't offer any products that are very competitive for all times of the year. It's very niche, and if people aren't wanting to do household projects and work on their decks and build new things and have all this free time that they may have had in 2020 and working from home and stuff, working on projects instead of actually working, their products aren't probably going to be flying off the shelves here. So they're probably priced close to a bottom, but they really have no reason to move higher, right? So I won't add any more capital into Stanley Black & Decker. Syscorp, this one isn't bad. I'm actually pretty surprised this one's at $76.45. I do not mind Cisco Corp. They're a pretty good services company. They deliver services all over the country to restaurants and to small businesses. And anytime they have these little dips here, I'm actually not worried when buying the Sysco Corp, the food delivery company, because when they do have these dips, it might take them a bit to recover, but they have always recovered since I've seen and kind of watched this company. There's always that time frame of recession periods here, but they do recover and they've done a really good job of it. So as long as they're able to work, they're able to make ends meet. And I actually don't mind. They're offering a 1.9, not the highest yield, but you can kind of see this yield is fluctuating here as well. So I'll have to look into why it's fluctuating so much. I think they're actually closer to a 2.4. I don't have a website. No, I don't actually have a website pulled up for them to kind of look at if they're offering like a better yield elsewhere than 1.9. I don't think that's the right yield. But I'd probably add Sysco Corp into my companies that I'd actually start buying up right now. Waste Management, priced at 156, started the year at 165. Not a bad company. It's a services-driven company, so their services are needed in residential areas and businesses to pick up and haul away trash. So while this company does have its ups and downs, people are always going to want to use it. A couple of my rentals use Waste Management. I can't buy any other services in that area to fit that need. So regardless of market fluctuations over time, it's just one of those needed companies that over time, regardless of what's going on in the world, will just kind of trend either lower or higher, but give it time, it'll just trend higher, right? So Waste Management is on my list of companies I would buy. WP Carey is a REIT, and with rising rates, I just don't want to be buying REITs at this moment, despite them being only slightly down. They started the year at around $80 and some change. They're now at 78, so they really haven't crashed really hard in comparison to all my other REITs here. They're offering still a really nice yield of 5.43, so not a bad one, right? If I were to buy just one REIT in my portfolio, it would probably be WP Carey. Okay, so I've looked at every single company that I currently hold, and of the companies that I would buy, I would probably chalk it up. Pfizer, no, I don't think I'd buy that one, right? I think it was these ones right here. So if I had to make purchases, I would probably buy into Johnson & Johnson, JP Morgan. Let me go ahead and maybe we'll do like a buy of the year right now with you guys. Our first buys of the year, just a couple $100 into each of these companies: Johnson & Johnson, JP Morgan, Lockheed Martin, Lowe's, Starbucks, Sysco Corp, and Waste Management. So 1, 2, 3, 4, 5, 6, 7, right? There's 7 companies here. So let's go ahead and I'm gonna move this over here. Move my thing, my tracker. And I'm gonna go into my positions here. And we're just gonna start buying. Whoops, what happened? We'll buy these 7 companies really quickly. I think it's a good start to the year. So J&J, oh my goodness, what is going on? Am I hitting a button I'm not supposed to be hitting? There we go. J&J. We go here and we go buy, sell. And we're gonna put $200 into each of these, okay? Nothing crazy, nothing fancy, $200. That should be pretty good to start off the year. Johnson & Johnson. Let's go back to our account, go back to our dividend beast. Let's go JP Morgan. $200 into JP Morgan. Let's go back into our beastie portfolio. Let's look up Lockheed Martin, ticker symbol, what was it, LMT. Let's go ahead and add $200 into this one as well. Confirm the buy. Then we got Lowe's. Let's go back and click on Lowe's and buy. And we got $200 going into that one. Continue and confirm. Then we got Starbucks. S-Bucks. Right there at the top. I see you. Don't go away. Starbucks. Buy. $200. Continue and confirm. And I know a lot of these positions are in the green, right? They're in the green. Why would I want to buy them? I'm just averaging up into these positions by buying into them right now. But, you know, if you tell yourself that all the time, like, hey, I'm going to wait to buy this company when it's down in red, then you're not going to be buying anything because you just can't make the commitment to it because it's not red. Why would I want to buy something when it's not red? It's I'm increasing my cost basis, and I can see that being really tough. But in this case, hey, we'll do it for you, okay? Okay, so there's all the buys. We have 7 buys. Let's look at the details here. So we're buying Lockheed Martin, Waste Management, JP Morgan, Johnson & Johnson, Syscorp, Lowe's, and Starbucks. So those are the companies we're going to be buying here. Again, let's go ahead and get rid of all of these that we are not buying. And we'll just do a quick snapshot of where these are at. So in the future, when I'm looking at what companies I bought at the beginning of 2023, we'll see where we are. So Johnson & Johnson, 176.65, trending above that 200-day, 50-day at 2.52% yield. JP Morgan, priced at 134.10, above 200-day, 50-day moving average, and a yield of 2.24. All of these are still off their highs for the year, right? Over the last year, Johnson & Johnson, oh no, it's actually higher. Okay, it's fine. JP Morgan is lower versus it was a year ago, offering 2.24. Lockheed Martin is a lot higher than it was just a year ago at $486. I honestly don't want to buy that one at this moment. I thought I did, but I'm just kind of buying into a really high price company at the moment where I think my $200 could probably go a lot better elsewhere, you know, in the future, maybe when it dips. Lowe's, I don't mind buying that one right now, right? $199, nearly 2% starting yield. Starbucks here, price at $99, not the highest it has been, but not bad, offering a 2% yield. Syscorp, price at $76 at 1.9% yield. It is trading both below its 50-day and 200-day moving average. And Waste Management at below 200-day and 50-day moving averages, price at a yield of 1.66. So I'm going to go ahead and remove Lockheed Martin from my buys. I think that's probably not like a horrible idea to be buying it right now, but I thought I had another position in here that I wouldn't have mind buying, but I can't think of it right now. Was it Siggy? I don't think anything else is what I want to buy. Well, we could buy WP Carey. Yeah, we'll buy WP Carey. I think we'll just toss the other $200 instead of into Lockheed. This one I know is not at its, you know, it's at its high, right? It's not beat down as much as my other REITs, but I think it still offers a really nice yield of 5.43 for its current price. It's not at highs, it's not at lows. It's kind of in between. So those are those 7 companies for starting off 2023 with buying, okay? Let me know down in the comment section below what companies you're buying yourself. We still have about $900 in cash, and we're going to be starting up our investment again, right? We have $6,500 split into 52 weeks. That means we get to contribute $125 every single week to this portfolio to cap out for the year of $6,500. Okay, this was a really long video, so I do appreciate if everyone sat to the very end. Let me know down in the comment section below if you guys sat to the very end just by typing in a comment saying, hey, I was here till the very end, and subscribe. Hit the bell to be notified with future videos, and let me know what you're buying. Okay, have a good day. Bye-bye.